And this is where the quant story really kicks in. Now we add the next major piece: credit default swaps. A credit default swap is just insurance on a bond or a tranche. Here's the structure. The credit default swap buyer pays a regular premium, usually quarterly. The credit default swap seller promises, if this bond or tranche defaults during the life of the contract, I'll pay you the loss. Originally, you had to own the bond to buy a credit default swap on it, but that requirement was removed. Then credit default swaps became a way to bet on default, even if you didn't own the underlying bond. In trader language, if you buy a credit default swap on a bond, you're effectively short that bond. You win if it fails. If you sell a credit default swap, you're effectively long that bond. You lose if it fails. Once credit default swaps existed for corporate bonds, they were naturally extended. Credit default swaps on collateralized debt obligation tranches. Credit default swaps on mortgage-backed security tranches. So you could now go short specific slices of mortgage collateralized debt obligations just by buying credit default swaps without touching the actual mortgages. Around 2004 and 2005, a few very observant investors started digging deep into subprime residential mortgage-backed securities. They found some supposedly safe securities were heavily loaded with subprime loans, sometimes 50 to 60% subprime. If conditions changed, these borrowers would likely fail together, regardless of geography. So they did the logical quant thing. They bought credit default swaps on those tranches, going short subprime mortgage risk. At the same time, big investment banks also saw that subprime looked dodgy. Some of their trading desks did something similar. They bought protection, credit default swaps, on the equity and mezzanine tranches of subprime collateralized debt obligations. These tranches were obviously risky, so credit default swaps on them were expensive. But the desks thought, if things blow up, this will pay off. The problem? In the meantime, they were bleeding premiums, money going out every quarter. Their managers asked, why are we paying all this money and not making anything back? So the traders looked for a hedge. Their idea was, we'll keep buying protection on the toxic lower tranches, but to offset the cost, we'll sell protection on the senior tranches, the supposedly safe AAA pieces. Credit default swaps on senior tranches were cheap because the market believed those tranches were almost bulletproof. But to match the money they were paying out on equity and mezzanine protection, they had to sell a lot of senior protection. The result was they were short a small amount of very risky equity and mezzanine tranches, and long a large amount of supposedly safe senior tranches through selling credit default swaps. On paper, it looked like a clever hedge. In reality, they were net long the overall mortgage risk, especially in the senior tranches. Whether this was safe or deadly depended on one thing: how correlated the defaults turned out to be. To price these collateralized debt obligation tranches, quants used a model called the Gaussian copula. You don't need all the technical details, just the key idea. Each company or mortgage pool has a hidden health variable that moves randomly. If it falls below a threshold, that name defaults. To simulate the whole collateralized debt obligation, you need to know how these health variables move together. That's correlation. Estimating a full 100 by 100 correlation matrix is hard, so quants simplified to a single-factor model. Assume that every pair has the same correlation and call it RHO. Then traders looked at market prices of tranches, backed out an implied correlation RAO that made the model match the prices. Got used to seeing numbers like 20%, 30%, 40% for good collateralized debt obligations. Over time, they became anchored to these correlation levels. It was just how the world looked in their models. But subprime mortgages were different. In a downturn, borrowers across the country with similar fragile financial situations tended to default together. Actual default correlation for subprime turned out to be much higher than the 20 to 40% levels quants were using, closer to something like 80 to 90% in stress scenarios. And here's the subtle but deadly effect of high correlation. When correlation jumps, senior tranches suffer much more than expected, while equity tranches don't necessarily get proportionally worse. Translated back to the real world, the desks were short the lower tranches, which, in this high correlation world, were not the main disaster, but they were massively long the senior tranches, precisely where losses blew up. So when subprime defaults surged and moved together, the hedged positions failed in the worst possible way. They made money on their equity and mezzanine hedges, but lost far more on the senior risk they had sold, in some cases making billions on the short side but losing many more billions on the long side, all because one assumption about correlation was too optimistic. The lesson from a quant perspective is simple and brutal. It's not enough to know how much risk you have in normal times. You have to understand how it behaves when everything starts moving together. Models are powerful, but they're only as good as the assumptions underneath. In 2008, one of those assumptions cracked, and the entire structure came down with it. If you found this perspective helpful and you'd like to see more videos exploring finance through math, feel free to stick around the channel. We'll dive into more topics like options, risk, and portfolio theory, all from a mathematical point of view.